Home appreciation, why it's a good time to buy, why the market is different this year than 2008, and what's in store for us next year on Housing News. So today we received our case Shiller update on home appreciation, and this is the gold standard for home appreciation in the U.S. We received some news that for the month of September, month over month, home values went down by 1% and are currently up 10% year over year. This brings home values in the U.S. down 2.5% from their peaks. And whenever we look at this report, what we want to keep in mind is that what's happening in this report is cities that were overheated, such as San Diego, Los Angeles, Denver, Seattle, were actually down 1.4%, and that's the 10-city average. And so these overheated markets are seeing some depreciation from their peaks, and this is bringing the national average down a little bit. This is also the September report, so we will continue to see home values slightly decrease November, October, December, because this is a lagging report and mortgage interest rates peaked in October. So we do expect to see some softness in the home market over the next couple of months. Once we start getting lower rates next year, we expect for the market to pick back up and become a seller's market, and we'll dive into that a little bit deeper. We also received our FHFA home value index, which is going to strip out jumbo loans and cash purchases. So this report actually came in much better than expectations. Expectations were that home values were going to decrease by 0.9%, and they actually went up by 0.1%. This brings this FHFA number to up 11% year over year. And in our region, the South Atlantic, it is online with the national at increasing by 0.1%. So whenever we stripped out jumbo loans, high loan amounts, we actually saw better figures. And this goes back to the overheated markets like LA. These places with high value homes are seeing less demand in that price range. And because there's lower demand, it's bringing some of these home values down. And we've actually saw 0.1% increase in home values whenever we strip out these jumbo and cash purchases. So we are seeing a good time to buy now. And let's go ahead and go into why this market is different than the 2008 market. Let's go ahead and go to a chart. So here we want to look at why the market's different and why it's probably going to lead to more of a seller's market in 2023. Back in 2007, on the supply side of the supply and demand chart, which is going to factor in that's where home value appreciation comes from. 2007, we had 4 million homes listed for sale and a record number of homes being built at the time. Today, we have 1.22 million homes listed for sale, with single-family starts down 22% year over year and single-family housing permits down 21% year over year. This is an indicator that builders learned their lesson back in 2008, and now that demand is decreased, builders are actually decreasing their construction. Back in 2007, the average home equity was only 19%. Today, it's 58%. Back in 2007, virtually non-existent on mortgage guidelines. Stated income loans, 0% down. You know, this is kind of what caused the demand to collapse back in 2007, 2008. You had all of these bad mortgages, bad loans that were compiled into mortgage-backed securities and were being traded. A lot of them had balloon payments. A lot of them were adjustable rate payments. And because they were these bad loans, whenever the Fed increased rates back then, it drove up these rates that people were having to pay. And a lot of people had to foreclose. And that's where the banks collapsed. That's where the demand completely shut off from the market. Today, we have extremely strict underwriting guidelines. They haven't changed much since 2008, whenever they were put in place. All income is verified. You have to put a certain amount down on almost all mortgages. They come with private mortgage insurance. There's not balloon payments. There's not prepayment penalties. All of these things make the mortgages that are currently invested in mortgage-backed securities much more stable. And you also have all of this home equity that people can rely on as well in today's market. So even with these high interest rates that we're seeing, 7%, 6.5% where they've been, they peaked in October, they're starting to come down. We are still seeing the median days on the market of a home listed is only 51 days. Last year, 45 days. Back in 2020, higher at 56 days. So this all brings into what is going to happen in 2023. Why is it going to be more of a seller's market in 2023? Because as the Fed gets a hold of inflation, which we saw with CPI data last month, with PPI data last month, and we hopefully will see with PCE data this Thursday, as inflation comes in check, interest rates will decline. And interest rates decline because they're an investment. The market's already factoring in a 50 basis point increase in the Fed funds rate in December. These are an investment, so investors are looking ahead on this. That's what affects mortgage interest rates. It's not exactly correlated to the Fed fund rate. So as mortgage interest rates decline, January, February, March, as we start to see inflation figures come into check, you'll see all these pent-up buyers come back into the market. We've got supply that's already historically low, 1.22 million, 51 days on the market. That's only going to go down. The peak in supply typically happens in September. So what's all this going to lead to is more of a seller's market. Home values going back up, less contingencies, less of a position for buyers to be in. So now if you could take advantage of purchasing a home before all of this comes into effect, before the seller market kicks in, you might be able to get a better deal. It's obviously about finding the right house for you, but also let's play the markets a little bit. Let's plan on a refinance coming over the next year. So that's kind of where we're at. If anybody has any questions on this, please feel free to reach out to me, email, call, text, follow me on Facebook for updates. We've got some exciting stuff coming out in January. I'm really excited to get out. And you can always follow me on Facebook, Instagram, or YouTube. And I hope everybody has a great rest of their day.